Welcome to Make Your Money Matter with Brad Barrett, the show that aims to change the way you think about wealth management. Brad is a financial advisor, established radio host, and author of Retire Right. He is a managing director and partner at One Capital Management, an SEC-registered investment advisory firm managing over $4 billion for clients across the nation. Brad and his team are dedicated to helping clients protect and preserve their assets so they can reach their investment and retirement goals. And now, your host of Make Your Money Matter, Brad Barrett.
Welcome in to Make Your Money Matter. I'm your host, Brad Barrett. I'm also a managing director and partner here at One Capital Management. And my goal, my aim on this show every week is to help you create a better relationship with your money. And today we're going to talk about some older concepts here this week, but I want to talk about as we're entering the first week of the fourth quarter of 2023. Did you follow that? And we're going to talk about some things like volatility. I want to define that today because we've seen that this year. And I think I've seen from many clients, we're talking about, oh my gosh, this quarter was, down, but the beginning of the year was so good. And I want to talk through that with everybody and really have us understand volatility. And then really the theme of today is going to be around context. Now, I know I say that word a lot, but it matters. Now, before we get started, make sure to go to our website at onecapital.com. There you can find out more about myself or any one of our advisors here at One Capital Management. You can also click on the media tab and download and subscribe to the Make Your Money Matter show. You can also download the podcast on any other platform like Spotify or SoundCloud or the Apple iTunes app on your phone. And do me a favor, leave us a review, give us a comment. It always is great to get feedback and it helps us share with the rest of the world. And with that, let's get started. So as we talk about things like volatility and, things like a looming recession and some of the stuff we've seen this year in the markets, we kind of have two thoughts going on, right? And I've shared a lot with this with clients and I've heard from each of you as well. And that's what I like to do here on our show each week is to share some of the concepts that I, as an advisor, am dealing with my clients on review meetings or new clients. And I'm going to sum up this week when I talk about these specific items around the word context. Now, I know many of you hear me say this word all the time, but it really does matter when it comes to how we look at things like our investments. I actually said on our podcast last week that I think I want to reiterate here, which is we got to be careful to take 30-year data or facts, right? A 30-year return on the S&P 500 or whatever, and compare that to a 1 year, or in this case, for example, 10 months of 1 year, right? Performance numbers. I think it's important to bring in context. Let me give you a little example of context. Years ago, a news reporter actually asked Michael Jordan if he thought the 90s Bulls could beat LeBron's Lakers. And Michael Jordan, of course, said yes. Now, the reporter then followed up and said, okay, by how much? And Michael said 2 or 3 points. And the reporter went on and said, well, why such a close game? And Michael Jordan said, well, most of us are almost in our 60s now. Friends, context matters, especially when you ask questions, especially of the greatest basketball player ever to live, even though I'm a Kobe fan. That being said, let's talk about some things here. Look, volatility rose during the last quarter. We just saw that. We just ended our last quarter here. This is the first week of the new quarter, the fourth quarter of 2023. And as such, concerns and fears among investors rose. So inflation staying stubbornly high. Obviously, central bankers are indicating that they may raise rates yet again, or at least not lower them anytime soon. That's one thing, right? This continued weakness in manufacturing that we saw and consumers really feeling the brunt of the high cost of goods and services. Obviously, we saw mortgage interest increasing. I mean, these are just to name some of the factors that I think are spooking a lot of investors out there. Now, these concerns, or even fear, I'll share, really caused investors, and I've seen this over the past 3 months in particular, almost lose faith in the financial markets. And we actually saw stock prices fall and bond yields rise, which really is not a great outcome for investors in this last 3 months. And I want to share something here. That's just 3 months, friends, but it's important to talk about. Now, we've all seen the word recession thrown around like every day. And it might be on the horizon or maybe even a soft landing, but a slowing economy in general is bad for profitability as consumers spend less. It's just math in that regard, and less to spend with inflation for obvious reasons. Now, inflation's stubborn persistence that we've seen throughout this year and even last year has investors questioning, I think, their belief that central banks will lower short-term rates soon, and therefore longer rates are too low, and has caused bond investors to demand higher rates on money invested longer term. This is where we get this inverted yield. Now, this has caused bond prices to actually drop, which including, pooled investments like ETFs and mutual funds, if you're in those, right? The longer the average maturity held, the longer you go out, the longer your duration, the more the price has fallen. This, by the way, may mark 2 years in a row that actually fixed income or bond investors with long maturity actually lose money. Now, as a side note here, friends, fixed income investors with One Capital Management, our firm, are actually faring much better than the average fixed income investor, largely due to our ability to manage effectively the duration, extending it when we feel like we needed to, as well as laddering or diversifying the durations within the exposure of our fixed income. Now, volatility. One hears, all of us, if we hear the term volatility on the news from investment people, guys in pinstripe suits in New York or whoever else, right? And even, by the way, in our own circle of friends, right? Periods of above normal volatility, like we saw in the third quarter of 2023, catch, I think, everyone's attention quickly. But what I want to focus here today on our show is, what does volatility actually even mean? Now, in statistics and really in finance, volatility refers to the degree of variation or dispersion of returns for a given stock or security, market index, you could even put in there, or financial instrument over a period of time. That's like the definition in our nerd financial world. And let me break it down a little further here. It's a measure of how much the price of any asset fluctuates around its mean, or otherwise known as average return. So volatility is often used to assess the risk, right? It's the risk associated with an underlying investment, or to make predictions about future price movements on that security or on that investment. There are several, I think, statistical definitions and methods of measuring volatility, but I want to go through two because these are the most common. And I want to share this today as more education and background as you look into this year of 2023, you look into the volatility, and you might be talking about it within your circle of friends. The first one is standard deviation. This is kind of like the mothership that we learn in economics, okay? The standard deviation is a statistical measure that quantifies the amount of variation or dispersion in a set of data points, all right? Now, in the context of financial markets, it's commonly used to calculate the volatility of returns. Okay, so let's put that into context. Remember, that's the theme of today. A higher standard deviation indicates greater volatility, as it really means that returns are more spread out from the mean, more variance. Now, the other definition of volatility is implied volatility. Implied volatility is a measure of market participants, you and I, and the expectations we have regarding future volatility. So it's often derived from option prices, which is why those exist, right? And using option pricing models, and those models can include like the Black-Scholes model and other ones. Now, high implied volatility suggests that market participants, again, you and I as investors, expect greater price fluctuations in the future. So volatility is a critical concept, which is why I want to focus on it this week on the show in finance and really overall risk management, because it helps investors and traders assess the level of uncertainty and really assess the potential risk associated with an investment or a portfolio. So different assets and markets can exhibit varying levels of volatility. I think that's important to note here. And I think understanding and measuring volatility is essential for portfolio management, what we do here at One Capital Management for our clients, as well as things like option pricing and overall risk assessment. Okay, so all that technical jargon I just mentioned to you helps investment professionals make decisions about current and future investments. So I want to put a timestamp here for a second. If you're working with an advisor or you're a client of ours, understand this. These volatility measures that we look at daily here at our firm in our portfolio management structure helps us assess and make decisions, right, about your portfolio, both in the current as well as in the future. So when we're assessing individual investments, we'll look at the return expected from the security and how much variation there may be around those expected outcomes. This is how you fundamentally derive a position that you see value in. And I think it's important to note, you can see very clearly it's very different than just somebody talking highly of a security or a stock and you thinking you're taking it at their word and, oh, it must go up because so-and-so said so, or all his points or her points made a ton of sense. No, you want to get into the weeds. And this is, by the way, one of many ways to value a company, but this helps us assess and how we make decisions as portfolio managers.
Stay connected. Get frequent updates on the show. Follow Brad Barrett and Make Your Money Matter on most social media platforms. And catch full episodes of Make Your Money Matter streaming now on our YouTube channel. To schedule your no-obligation appointment, go to onecapital.com or call 805-410-5454.
What I just said there lastly around, how much variation there may be around those expected returns, the higher the variance or standard deviation, as I mentioned, the greater the chance of higher than expected returns or lower than expected outcomes may occur. So this analysis using data and really math helps allow, I think, for better informed decisions. I want to repeat that. Better informed decisions when deciding whether or not to purchase or sell, for that matter, any given stock or security. The analysis can be done on individual companies, okay? It can be done on fixed income securities like bonds, or even baskets of securities like ETFs, exchange traded funds, or even mutual funds. Now, volatility in general, friends, going back to that for a second, it isn't bad or good. It just is. I know, don't you love that statement, right? It just is. It's neither good nor bad, okay? So the question really comes is, how does one try and manage volatility? Because at the end of the day, as you hear me say often, right, the one certain thing that we're going to have in life is uncertainty. The fact that we think it's just going to go straight up from here or in any time period is kind of ludicrous. So we really have to ask the question, how do we manage volatility? And ultimately that gets into how we manage a portfolio. And frankly, there are a number of ways to try and control large swings in prices, but the first is to buy more than just one security. So what, friends? Not all of our eggs are in one basket, as the old saying goes. So you start off with, I know it's an overused word, but man, is it important, diversification. Buying multiple securities of different, we'll call them characteristics, right? Such as economic sectors, large and small companies, geographic regions, fixed income versus equities. I mean, these are just to name a few. This is diversification we hear so much about, and it works over time. Setting risk parameters helps. It does, it helps, and data shows this. Knowing that prices fluctuate and returns vary with different conditions helps control really what I share often, which is the emotional swings that are often felt with volatility, especially higher than expected volatility. Time is also a great help here as well. Keeping a long-term perspective allows all of us as investors to weather, I think, the short-term swings and focus on our ultimate goals with our money. Now, with volatility, I also want to share this, and I talk about this a lot. When you know what you're looking at, volatility can be a really good friend to you. Said differently, with volatility comes opportunity. Fear and uncertainty cause less disciplined investors, quite frankly, I'm just going to call it that, to panic and make decisions based on emotions, which, friends, is never a good thing. I want to restate that for a second because I don't want you to be one of these people. Fear and uncertainty cause less disciplined investors to panic and make decisions based on emotions. Today's concerns, let's put it this way, today's concerns will be tomorrow's past soon enough. Think about all the things you were thinking about earlier this year or last year or year before or through the pandemic and how those aren't as of concern to you now, but you've now created new concerns. Let's talk about some things as we end here today. Inflation is coming down. Interest rates are close to their peaks as a slowing economy will push rates back down. The world's economy is resilient. We're seeing that fundamentally, and in our opinion, will rebound in the coming year. Opportunities are there for those that stay the course and let the noise of today pass them by. I want to share that today as a message for all of us as we're looking into the longer term contextual idea around managing any investments you have, or specifically your retirement. Hey, I want to thank you for listening to the Make Your Money Matter show. As always, before acting on anything discussed today, make sure to speak with a financial professional near you about your specific situation. Or again, if you'd like our help, you can reach us at 805-410-5454. And until next week, always remember to make your money matter.
The information in this show is educational and general in nature and does not take into consideration a listener's personal circumstances. Therefore, it is not intended to be a substitute for specific individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.